In 2007, a group of investors identified a company worth $3 billion. They didn't have $3 billion sitting in accounts. Instead, they did something that sounds impossible but is completely legal. They borrowed most of it. Within 5 years, they sold that company for $7.5 billion. They made $4.5 billion in pure profit, but here's what makes this interesting and not insider trading. They only risked a fraction of what they ultimately gained. They didn't put in $3 billion and lose it all. They put in maybe a few $100 million. Everything else was borrowed. The company's cash flow paid back the debt. And what remained was their profit. This isn't fraud. It's not uncommon at all. It's the most effective wealth multiplication tool in modern finance. And it's designed so thoroughly that only certain people with serious capital and serious institutional connections can access it. Everyone else watches from outside, wondering how it actually works. This is that story, and by the end, you'll understand why the economy is organized this way. Set up, WHY this matters. Now let's start with something you probably feel in your gut already. If you want to buy a house today, you need about 20% down. That's the rule. That's what banks require. But if you want to buy a company, if you want to acquire a business, the math works completely differently. That's not a coincidence. That's not random variation. That's intentional design. That's architecture built into the financial system. Right now, firms with names you've never heard of own pieces of everything in your daily life. They own apartment buildings you might rent. They own dental practices where you get your teeth cleaned. They own the gyms where you work out. They own nursing homes where your grandparents might live. They own funeral homes, parking companies, restaurant chains, and retail stores. And the mechanism by which they've accumulated all these assets isn't particularly mysterious. You could learn how it works, but the reason it works so much better for them than for anyone else trying to build wealth, that's where this gets genuinely interesting. The uncomfortable part, the system isn't broken. It's working exactly as designed. It's just designed for a specific category of person, and if you're watching this, you're probably not in that category. The question isn't whether this is fair. The question is whether you understand how it works, because once you do, you start seeing it everywhere. The mechanism, walk through how this works, then where big players gain advantage. Imagine you have $1 million. You find a business worth $10 million. Normally you're done, but here's what happens instead. You put $1 million down as equity. You borrow $9 million from a bank. You control a $10 million asset. You own it legally. The bank has a claim on cash flows, but you make all decisions. The bank wants principal and interest back every month. This company generates $2 million a year profit. You pay $1 million to the bank as debt service. You keep $1 million. Stop and think. You started with $1 million of your money. You own a $10 million asset. You've kept your capital and captured something 10 times larger. For comparison, buying the traditional way requires $10 million of your own capital. Same company, same profit, but $10 million at risk instead of $1. Same asset, different capital structure. This is the core advantage. Over years 2 through 5, you run the company well, improve processes, cut costs, raise prices, improve experience. The company's profit grows from $2 million to $4 million a year. Legitimate business improvement. The company was worth $10 million at $2 million profit. Now at $4 million profit, it's worth $20 million. You've paid down $2 million of the loan. You owe $7 million instead of $9 million. Your equity went from $1 million to $13 million. You've tripled your money by controlling an asset that only doubled in value. That's the multiplier effect. 300% return over 5 years is roughly 35% annualized. Stock market does 10%. You're looking at 3 times better returns on the same business. This is the mathematical magic. The hidden advantage, where size actually matters. Now here's where the game changes completely, and where size gives you an edge that's almost impossible to overcome. If you're a regular person with $1 million in savings, a traditional bank won't lend you $9 million to buy a company. The risk profile is wrong from their perspective. They want your personal guarantee on the debt, your house, your car, your savings, everything on the line. If the deal goes sideways, they can come after you in bankruptcy court. A bank lending $9 million to an individual is nervous about that $9 million. They're pricing risk at the higher end. They're charging you higher interest rates to compensate. Maybe equity kickers where they share in upside, restrictive covenants telling you exactly how you can run the company. On a $9 million loan, a bank charges you 8% interest. That's 720,000 a year in interest payments. 720,000 a year going to the bank instead of your pocket. Now imagine you're not a person. You're Blackstone or KKR or Apollo Global Management. You've done acquisitions 50 times. You have billions of capital behind you. 100 billion, 200 billion. Banks don't want to miss out on lending to you. Banks are competing with each other to lend you money. You're the prized client, everything changes. They charge you 4% interest, maybe 3.5%. On the same 9 million loan, you're paying 360,000 a year. That's 360,000 more dollars every year staying in your pocket instead of going to a bank, just from interest rate differences. But that's only the beginning. Mega funds negotiate the entire structure of the debt, interest-only payments for 5 years instead of full amortization. Call options allowing refinancing at lower rates, flexibility around principal repayment, covenants so loose they're essentially unenforceable. A regular company is on a standard amortization schedule, principal and interest every single quarter, no flexibility. Miss one payment, the bank forecloses. The fees are different too. When a megafund borrows, they negotiate lending fees with major banks. The banks sometimes eat those costs because they want the relationship. A small business owner pays the full fee. Origination fee, processing fee, underwriting fee, these aren't standard. They're negotiated based on who you are and your leverage. Interest rate advantage plus structural advantage plus fee advantage. It stacks and compounds across every deal a megafund does. Systemic amplification, how this becomes structural. A megafund has $15 billion of capital that they've raised from institutional investors. Because of the lending advantages we just described, they can deploy that capital into acquisitions and control $60 billion in assets. The average private equity firm uses about $2 to $3 of debt for every dollar of equity they put in. Thousands of funds do this globally, not hundreds, thousands. Blackstone manages roughly $900 billion. Apollo manages $600 billion. KKR, TPG, Carlyle. These firms collectively control hundreds of billions in assets across every sector of the economy, every industry you can think of. Real estate, healthcare, retail, infrastructure, technology, manufacturing. Megafunds have become the dominant ownership model for most private companies. If a small business is doing well, if it's generating consistent profit, it's only a matter of time before someone with capital shows up and makes the owner an offer. The owner gets liquidity. They get to stay involved sometimes. The fund gets leverage. The bank gets lending fees. Everyone makes money, except the economics flow upward to those who already have serious capital. The feedback loop is brutal. As megafunds accumulate assets and returns, they grow larger. As they grow larger, they negotiate better lending terms with banks. As they get better terms, they can outcompete smaller players who don't have that leverage. As smaller players get squeezed out, capital becomes more concentrated. The multiplier effect is structural and self-reinforcing. It's not accidental. You see this everywhere. The apartment you might rent, the dental practice, the gym, the nursing home. The infrastructure you use, ownership is reorganizing in real time. Not evil, not conspiracy, just a system that works very efficiently if you have access to it. The uncomfortable truth here's where we need to be honest about what's actually happening beneath the narrative you hear in business school or financial media. The story about megafunds is that they're brilliant operators. They buy companies, improve them, sell higher. Sometimes that's absolutely true. But increasingly, the returns aren't coming from actually making companies better. They're coming from financial engineering and cash extraction. A fund buys a company for $100 million. 20 million equity, 80 million borrowed at favorable rates. The company makes 15 million a year profit. Borrowing costs 8 million. That leaves 7 million available to equity holders. That's a 35% return on their 20 million investment year one. That's genuinely great, but watch years 2 through 5. They optimize cash flows for extraction, cut costs aggressively, reduce research and development, minimize reinvestment, cut headcount sometimes dramatically. The company now makes 18 million a year profit, not because the business is fundamentally stronger, because costs got cut. They're extracting that cash immediately. Sometimes taking dividend distributions back to the fund, paying down debt slower than they probably should. In year 5, they sell, maybe 130 million now based on higher cash flows. They pocket 70 to 80 million after paying off remaining debt. Their 20 million became 70 million. That's a 3.5 times return. That's 70% annualized. But here's what nobody talks about. The company is now structurally weaker, more leveraged, has less operational flexibility, less cash reserves. If the industry faces a downturn, it can't weather it the way it could have before. The next owner, if there is one, inherits a more fragile asset. When the game stops repeating, when there's no one left to buy, these companies break under the debt weight. The strategy works until it doesn't. The bigger picture, the hidden money multiplier, isn't really hidden at all. It's leverage combined with favorable access to capital, combined with financial optimization. The only big player's part isn't because it's illegal or secret. It's because banks will lend large amounts to megafunds at favorable rates with flexible terms, but they won't lend the same way to individuals or small companies. The risk profiles are different. The megafunds have diversified portfolios and professional management. An individual has one shot. This creates a structural advantage that compounds over time. A megafund with $200 billion can access capital cheaper and faster than an entrepreneur with a proven track record running a profitable company. That's not a flaw in the system. That's a feature. The system is designed to concentrate capital and control among large institutional players. The uncomfortable part is the feedback loop. As megafunds accumulate assets and generate returns, they grow larger. As they grow larger, they negotiate better lending terms. As they get better terms, they can outcompete smaller players. As smaller players get squeezed out, capital becomes more concentrated. It's self-reinforcing. The multiplier effect isn't just financial, it's structural. You see this everywhere now. The apartment you might want to rent is probably megafund owned. The business your parents sold years ago is probably megafund owned. The dental practice down the street. The nursing home your grandparents might move into. The funeral home in your town. It's a reorganization of ownership happening in real time. Most people don't even notice it's happening. This isn't evil, it's not a conspiracy. It's a system that works very efficiently if you have access to it, and works against you if you don't. The people making the decisions all benefit from it working exactly this way. So here's the question that doesn't have a clean answer. If the system is working as designed, and the people making decisions all benefit from it working exactly this way, what actually changes? What would have to happen for the incentives to realign? When do the returns from extraction stop being available? When you've optimized cash flows from most of the economy, what's left to buy? What happens when there's nothing left to acquire and returns start declining? Does the system find new markets to extract from? Does it collapse under its own leverage and debt burden? That's where the real conversation starts, and honestly, nobody really knows what happens next, but whatever it is, it's going to matter.